geographic arbitrage in the United States will not allow inflation to go as high as people expect. Our contrarian view on the next maybe half year to year is that we will not have the kind of inflation that everybody's talking about. We have a good chance for robust growth, which is growth with moderate inflation. And our belief is that the markets are starting to price that, but the narrative in the market is not yet at that level. I will explain why. In particular, what we call the great geographic arbitrage in the United States. This is a Not Even Wrong podcast. It's January 7th, 2021. We have no further update from the first episode. We're up 21%. Market's up about 1.5%. Actually, I said 1%. So we're outperforming by something like 19.5%. Let's talk about specifically what the thesis is, what the contrarian view is, and the implication. The thesis is that we have a great geographic arbitrage in the United States happening because of COVID, and like everything, according to our thesis, which is another, I think, contrarian thesis, or to use Peter Thiel's word, something that I believe in that most people don't believe in, which is that nothing that is relevant for the financial markets actually is caused by COVID. It's accelerated by COVID, but all the developments were already there. So the fact that Tesla was doing well even before COVID. Now it's doing even better, and the stock is up because of valuation and things like that. But because of multiple expansion driven by the money that is flowing into the market because of COVID. So what I'm trying to say is the development has already been there. What has changed is that COVID is accelerating it. And here's another thing that we think is a massive demographic shift in the United States, and that is the great geographic arbitrage. People moving away from the coasts into areas like Texas, Utah, Nevada, Florida on the East Coast, arbitraging housing prices, healthcare costs, school costs, jobs. The great United States geographic arbitrage is happening, and in our view will bring down inflation. We will still have inflation, but it's not going to be as high as people expect. Here's why. Like I discussed in the first episode of today, there's three levels of inflation. It's labor cost, it's housing cost, and then there's a bucket of healthcare, safety, and education. All these three drive inflation, and in particular, the kind of inflation that we care about as Orange Capital Partner, sort of knowledge worker type people. We care about those types of inflation. And because we lived on the coast, in particular in San Francisco, and before that in New York, we were constantly facing the real inflation in this country, which is labor costs, healthcare, housing, education. All these things have been going through the roof and are going through the roof. Our thesis is that that trend will stop because of the great geographic arbitrage, people moving away. Here's an example. So you have high housing costs in San Francisco, you move to Reno, you have probably up to 50-60% less housing cost in Reno than in San Francisco. So while demand in Reno is going up, the demand in San Francisco is abating. So if, let's say, a house that was 5 million is only worth 3 million now, you lost 2 million. And if the house in Reno went from 1 million to 1.5, you gain half. So my point here is that this great arbitrage is going to lower generally housing prices in the United States. This is thesis number one. Thesis number two, we have healthcare costs and schooling. I think a lot of people moving away from the coasts to states like Texas, Utah, Nevada, again, apparently they're moving because of state tax. I don't believe it's the state tax. The state tax makes a difference, but what's really taxing people is the high healthcare, high education, schooling costs, high housing costs. All of these things are related, and all of these things are going to be arbitraged in the same manner that I just described. You're moving away from San Francisco to Reno. You have much more efficient healthcare. It costs less. The schools are to most extent, you can just send your kid to a public school, so you save tens of thousands of dollars on education. All of these trends, in my view, are going to abate inflation. This is the view, this is the contrarian view, that despite the money printing of the Fed, we will have less inflation than people expect. We still could have the kind of 2% implied inflation that the 30-year Treasury is pricing in right now, but that's fine. We could have 5-6% nominal growth driven by massive innovations. I discussed that also in the first episode, robust growth driven by the electric intelligent car, the cloud computing advances, AI advances in many areas of normal life. We have quantum computing, we have interplanetary travel, and we have cryptocurrencies. So those are all things which have massive disruptive power and therefore could drive inflation down. Disruption, the way we see it in particular, is always getting better and cheaper at the same time. So if we have this kind of combination of disruptive forces plus an abatement of inflation, we could actually see a robust growth story for the United States with less intervention of the Fed than expected, with less rising interest rates, but less. We could actually have a pretty balanced view. The risk with all this is leverage. With lower interest rates, we have much higher leverage in the financial markets. That is a problem. Leverage is always a problem in the financial markets. It will also be a problem this time. It is like human nature. You give people cheap credit, they will use it, and they will go crazy about it, and it will cause problems. So there is no question about that. This will cause problems and that we will have corrections in the market, etc. But those are things that we have to live with as long-term investors. The purpose of Orange Capital Partners is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. This is the purpose of the fund, and wealth generation is directly driven by fundamentally new concepts and engineering practices. That's what actually drives wealth. And therefore, we believe that short-term corrections because of leverage and interest rate spikes and things like that, because maybe there's a correction in the market driven by liquidation, somebody over-levers, etc. Those kinds of things will happen. But what we don't think, and here's the contrarian view, we don't believe that buying metals, Bitcoin, and these kinds of things is a trade that you need to put on for inflation hedges. It doesn't mean the trade might not work. The trade might still work for other reasons. Because, for example, I don't know, maybe Bitcoin is undervalued. It's possible that the value of this asset is in the trillions. So it can go up 3-4 times. That's possible. I can't doubt, but I don't think that you need to use inflationary mathematics here to gauge the value of the asset, if you use inflationary mathematics, you will be wrong. You will not find the value of Bitcoin and gold and copper and all these things. It is overpriced relative to where we think inflation will come. There's a good chance that because of the great geographic arbitrage in the United States inflation will actually stay low for a while. It's kind of comparable to Germany. When East and West Germany merged, prices collapsed in Germany for many reasons. Labor costs came down, housing prices came down. We see a similar event, of course, different reasons, but a similar event happening in the United States. And therefore, we are coming out with a call today on January 7, 2021, that we will have robust growth. So very good nominal growth with very moderate inflation, and therefore very, very strong call on financial markets and their performance. Thank you.